Okay, let's see if we can get through exercise 5-28C, which is on the net method for recording sales, purchases, shipping, and returns for both buyer and seller. This is, of course, Chapter 5 on merchandising. So we start at the top. The following information applies to the questions displayed below. Sydney Retailing, which is the buyer, and Troy Wholesalers, which is the seller, enter into the following transactions. On May 11, Sydney accepts delivery of merchandise, so it's a purchase transaction. On May 12, Sydney returns part of that purchase from the previous day. So we have a purchase return transaction. And again, I'm talking in terms of Sydney Retailing, which is the buyer. And then on May 20th, Sydney pays the seller for the amount owed. So we have three transactions, May 11, 12, and 20. And so we're going to have to record this first on the buyer's books, and then secondly on the seller's books. So why don't we start with the buyer. Part 1, prepare journal entries that Sydney Retailing, which is the buyer, records for these three transactions. And we're going to record these in journal entry format. Sydney accepts delivery of $44,000 of merchandise it purchases for resale from Troy. Invoice dated May 11. Terms are $310 net 90. FOB shipping point. So first of all, let's talk a little bit about the terms. Terms in merchandising, terms are generally stated, as you see here, 3/10, comma, N/90. What that refers to is that the buyer gets a 3% discount if paid within 10 days from the invoice date being May 11. Otherwise, the net amount is due in 90 days. The full amount is due in 90 days. And free on board, FOB free on board shipping point refers to at what point title passes. So if the goods are purchased free on board shipping point, then the buyer is assuming ownership from the point of shipment, which is generally going to be the seller's dock or warehouse. So in that case, the buyer owns the goods in transit, and the buyer assumes the risk of loss for that merchandise in transit, which generally is going to mean that however the buyer is having the merchandise shipped to the buyer's place of business, they're going to have to ensure that there's adequate insurance in force to cover the risk of loss of that merchandise. Okay, so let's record this purchase, first of all, on the buyer's books, and we are recording this on the net method. So net method generally refers to the discount involved in the transaction. And so when we record a merchandising transaction using the net method, we calculate the discount and subtract it from the amounts being recorded. So in this case, our purchase is for $44,000. and the discount is 3% on 44,000. The discount is $13.20, so the net amount of that purchase, net of discount, is 44,000 minus $1,320, or 42,680. Now, using the perpetual inventory system or method, our debit on a purchase for the buyer is going to go to merchandise inventory account. And the debit, normally, if we were using the gross method, we would debit merchandise inventory for 44,000. But because we're using the net method, we calculate the discount and subtract it from the invoice price, and we record it net of the discount. So that's going to be 42,680. Now we're purchasing, the buyer is purchasing on credit. Since terms are 310 net 90, that signifies a credit purchase. So our credit account is going to be accounts payable. It's amounts owed by the business. And just as for the debit to merchandise inventory, we also credit accounts payable for 42,680. And I wonder if it's going to accept a purchase of merchandise terms 310 net 90. Now, I'm not sure if it's going to accept that. No, it doesn't. Okay. So it doesn't accept any kind of explanation. So we simply record it. And just do a quick check that our first entry is correct, and it is correct. Okay, so we're on the right track. Okay, second entry. Second entry. The goods cost Troy $32,000. Sydney pays $310. Sydney pays $310 cash to express shipping for delivery charges on the merchandise. Now, since we are recording transactions for the buyer is not involved with the cost of those goods, the cost of that merchandise in the hands of the seller. Troy, again, is the seller. So we don't, the buyer doesn't record the 32,000. Rather, the buyer is paying cash for shipping. And so we need to debit the amount of the shipping. Now, if we were using a strict perpetual method, we would debit merchandise inventory. I'm not sure if this is going to work out, but we'll debit transportation in, which is a merchandise related cost or expense account. We'll debit that for the amount of the shipping, and it was paid in cash, so we will credit cash also in the amount of $310. And so let's see if that's going to work out for us. And no, it's not accepting transportation in, so it is on the strict perpetual method, which means we debit that entry directly to merchandise inventory. So the amount of the transportation in or freight in is debited or added to the merchandise cost account, merchandise inventory, the asset account. So we can check that, and sure enough, that's correct. And so we can go on to the next entry. Sydney, again the buyer, returns $1,100 of the $44,000 of goods to Troy, who receives them the same day and restores them to its inventory. Now, we're not going to be concerned with what the seller is doing in these entries, because these entries are strictly for the buyer. So the buyer is returning $1,100 of the $44,000 of goods to Troy. And just as we deducted the 3% discount when we recorded the 3% discount as when we recorded the purchase. So we took the 44 and we deducted the discount, which came to $1,320. We're going to have to do the same thing here on the return. So we have a reduction in the amount owed, accounts payable, and it's $1,100 less 3%, and 3% on $1,100 is $33. So we take the $1,100 and we subtract 33, and our net purchase return or reduction in our inventory and amount owed is going to be $1,067, and that's our debit. So that essentially reduces the amount we owe on that order, and our credit is for the same amount, $1,067, and the account that we use is going to be our merchandise inventory. And let's see if that's going to work for us, and it does. So let's see, maybe we can get a small little worksheet, Excel spreadsheet up here, and show some of our calculations. It might make it a little bit easier. Here we go. And so we have exercise 5-28C. And our this is on the buyer's books on May 11. We have a purchase of $44,000. Let's say purchase of merchandise. And our purchase, our cash discount, if paid by 10 days from May 11 is May 21, is $1,320. And so our net purchase, hence the term net method, is $42,680, which is the amount that we recorded on that journal entry. And then on also on May 11, we had a freight in on merchandise of 310. Hitting cash. And okay. And then on May 12, we have a purchase returned. Return of merchandise, and the invoice amount on the merchandise return is $1,100. However, we are recording it on the net method, so just as we did for the purchase, on the return we also subtract the discount and record that net of discount. So that is our net purchase return 1067, and we already checked it. We know it's correct. Okay, so I think using this spreadsheet makes it I think it's helpful to get a feel for the calculations for these transactions as we go through them. And then let's go back to the worksheet, and the second part of that transaction says the returned goods had cost Troy $800. And again, Troy is the seller, and so as the buyer, we are not concerned with the amounts that pertain to the seller. When we get to the seller's journal entries, then we'll have to deal with the amounts that pertain to the seller. Okay, so that's it for the buyer on transaction 3. And then finally on transaction 4, on May 20th, Sydney, the buyer, pays Troy for the amount owed, and Troy receives the cash immediately. So let's see how much that payment is going to be. And so this is on May 20th, and the amount of the purchase net of discount is 42,680, and then the amount of the return also net of discount is 1067, and so our net cash payment will be the total of these two, which is 41,613. And so we are going to debit accounts payable. What is the amount again? Our amount was 41,613 as a debit, and a credit to cash of 41,613. 613. And so we can look at all of our journal entries and we are okay. All right. So we have recorded our transactions on the buyer's books. Now, I believe the next step is going to be the seller's books. Yeah, part 2 on seller. Same transactions. However, we are recording those transactions not on the buyer's books, but on the seller's books. All right, so let's move ahead with part 2, recording these transactions on the seller's books. First transaction on May 11, record the merchandise sold on account. So as you might recall, the purchase price, which is also the purchase price for the buyer, is also the selling price for the seller. So that's $44,000. And on the buyer's books, we debited merchandise inventory for the amount of the purchase less the discount. However, on the seller's books, this amount is not a purchase, not added to inventory. Rather, the credit, first of all, is to sales. And the amount of the sale is recorded at net. And, you know, I think it's important to note that in transactions like these, the buyer could be using the net method and the seller could be using the gross method, or the buyer could be using the gross method and the seller could be using the net method, or both buyer and seller could be using the net method, which is the way we're going to record it, or both buyer and seller could be using the gross method. So for illustration purposes, we're assuming that both buyer and seller are using the net method. So the calculation on the seller's books will be the same. And the transaction dates are the same. However, the nature of the transaction is different depending on whether you are the buyer or the seller. So for the buyer, we had a purchase of merchandise. For the seller, we have a sale of merchandise. And again, we start with 44,000 and we deduct cash discount again on the buyer's books if paid by 5/21, but on the seller's books that date is still 5/21 because the terms apply to both buyer and seller. However, for the seller, it's based on collection date. So we subtract out the discount, and the difference is our net sale, which is the same amount, 42,680. And since this sale is on credit on the seller's books, we will debit the asset accounts receivable and offset by a credit to sales of 42,680, and we want to check that we're on the right track here, and we are. Okay. Then on, let's see. On same date, but relating to the cost of the goods sold. Now, this is a piece of information that relates only to the seller. And so we want to insert sheet rows and use the same date here for the seller. And on the seller's books, we want to record the cost of the sale, which was $32,000. Now, because the discount relates only to the sale at selling price to the buyer, it has no bearing with respect. The discount does not affect, it has no bearing with respect to the cost of the merchandise sold. So that remains at $32,000. Let's take these rows out of here. And so we want to record a debit to cost of goods sold of $32,000, and our credit is to our merchandise inventory account, $32,000. And of course, we want to make sure that we're on the right track here, and we are. Okay, again, now this merchandise inventory is the seller's merchandise inventory account, not to be confused with the buyer's merchandise inventory account. These are two companies and they're independent of each other. Okay. Now we can go on to the third entry, record the sale return. Now the sale return was made by the buyer, and the buyer returned $1,100 of merchandise. And notice the freight, which was paid by the buyer, has no effect for the seller. So there's no entry on the seller's books for the freight that the buyer paid. Okay, so we're on the return, and we have a return of merchandise, and again, the amount is $1,100. And just as the buyer subtracted the amount of the discount on the purchase and the return, so too will the seller record the amount net of discount on both the sale as well as the sale return. So our cash discount is the same 3% on the 1,100, and the difference is our net sales return. $10.67. And so our entry for the sale return is to debit our sales returns account for $10.67, And our credit, since we sold on credit and we debited accounts receivable, our credit account here will be our accounts receivable, because this will affect the amount that is owed to us. And that's reduced by 1067. And again, we want to make sure we're on the right track here. And we are. Okay, so we have our sale, our cost of sale, our sale return, and now we're on our next transaction, which is record the cost of the sale return. Now, again, the buyer didn't have to do this entry. This is the seller's entry. And so we need to show that cost of this sale, amount of merchandise returned is $1,100. Now, how are we going to get this amount here requires a calculation, and that calculation is going to be calculated based on our cost to retail percentage. So if we take our cost and divide it by our retail, we see that our cost percentage is 0.727273. Cost percentage, cost over retail. And let's show that as a percentage. (72.73%). And so our net credit, our net, let's call it a reduction in sale amount, is going to be based on our cost percentage, and that amount comes to $800. So again, the seller's selling price was $44, so the sale return was based on the selling price $1,100, but net of the discount, the seller recorded $42,680, and the sale return net of the discount was $1067. Now we need to also, the seller needs to also show that of the cost of sale of $32,000, this merchandise is essentially being returned to inventory at the equivalent amount of 32 over 44, which is this calculation here, which I am applying to the amount of the sale return at retail to give us a net return of merchandise to the seller's inventory of $800. Now, I hope that makes sense. So let's show that as a debit back into merchandise inventory, and our credit would go to cost of sales, because our entry to record the cost if you recall, entry to record the cost was a debit to cost of goods sold and a credit to merchandise inventory. So to record the cost on a sale return, we would simply reverse that entry, debiting back the $800 back into inventory, assuming that returned merchandise goes back into inventory at cost, and a corresponding credit to cost of goods sold, which is a reduction of the cost of goods sold on that sale. And so let's check that entry. Hopefully it's okay, and it is. So far so good. We're on the right track. And then finally, our transaction for payment. So on May 20th, on the buyer's books, Sydney made a payment net of the return. On the seller's books, they're going to be collecting that payment, also net of the return. And so, I'm sorry, this is the wrong date. This entry should be dated May 12th, and then we have the payment entry for the seller, which is on May 20th. And that's going to essentially, the numbers are going to be the same here. However, it's going to be a sale net of discount, then the return net of discount, and our net cash, not payment, but received, is 41,613. And so we want to debit cash for 41,613, and our credit goes to accounts receivable also in the amount of 41,613. And again, we want to make sure that we're on the right track, and we are. And so we're done with part 2. I'm sorry, that was part 3. And so let's go on to part 4, which is, well, I know I had set these up as continuous exercises. So this is actually parts 4 and 5 are actually the next exercise, and so I'm going to leave these blank. I'm going to save and exit. Yeah, I'm going to save and exit in case I want to come back to exercise 5-29. And so we can always go back to that. I'm also going to save this worksheet. Let's see. And this is going to be exercise 5-28C worksheet for Hillary. And that way I can send out both the video as well as the worksheet. So at this point,